Hey, happy Thanksgiving and welcome back to the channel. Today I'm going to be going over another ETF face-off, but this time it's between a Vanguard fund and a BlackRock fund. I'd also like to mention that this week is Thanksgiving and I hope everyone has a safe and merry holiday. Now, why did I choose these two ETFs? It's actually pretty simple. These two ETFs make up a big part of one of my biggest accounts that I have today when I moved over from Betterment to Wealthfront, and I thought it'd be good to investigate them. Now, for those who've been watching the channel for quite a while, you'll notice that I've done several of these ETF face-offs. I did one back in January and I did one back in May. I'll make sure to link those right up here, so take a look at those if you haven't already. Now, first things first, which two are they? Well, you know from the thumbnail, VTI and ITOT. If you are invested in one of those, I'd love to know down in the comments why, as we're going to get into both, and then I'm going to give you my prediction of what you should go with and when, as well as who is the typical buyer of each one of these ETFs. So first up, I just want to go over to Google Trends. I always like going through this and seeing what the country's searching for, when, where, and why. Between these two funds, VTI and ITOT, you have VTI being searched a lot more, especially when it comes to some of the different states. So North Dakota searches for VTI more than ITOT, which I thought was crazy. Minnesota. If anyone's familiar why it's like this, comment down below. I really don't understand why there's such a difference even from states. So if I go up here to Maine, VTI, ITOT is barely even searched. It's crazy. Now, if I go up to District of Columbia, it looks like it's being searched more there than it is somewhere like Florida. Again, I'm not really sure why, but if you do, please comment down below. I'd love to know. Now, if I look down here at IoT, it looks like it's the most popular in Minnesota, Washington, Texas, Georgia. For some reason, Virginia really likes ITOT. Again, I don't know why. Now, first off, let's actually go into the Vanguard Total Stock Market ETF. This is an ETF that I myself own, and I've owned it for a very long time. What makes it so great? Well, very, very low expense ratio first. So if anyone can actually remember back to one of my first videos, it was talking about why investing in Vanguard index funds is so profitable, not to mention the low expense ratio that comes with it. Well, this puts it right on the map as perhaps, I'll have to double check, I believe it's the cheapest expense ratio you can get for a total stock market ETF, whether that's S&P 500 or international, as well as some of the best performance. So year to date, 18.60, net asset value 18.55%. That's as of today. It's being filmed on the 21st. And all this is trying to do is seek the total US stock market return for the index. And the expense ratios, like I said, are very low. Let's look at some of the returns over the last, let's go quarterly. Actually, you know what? Let's go annually. If I go back all the way to 2008, you'll see, let's go total return by market price. This year was 30% and the benchmark was 30. So it basically tracks just along with what the benchmark is. Similar funds, 0.78. That's one thing I want you to remember is what does an average expense ratio of a similar fund look like? Well, it's almost, what is that, 15 times, 30? No, it's almost 25 times higher. Wow, 25 times higher than what you would pay investing in this. Now, what is it actually investing in though? So, well, if we go down here, we can actually see a lot of it is, let's see, yeah, technology. Yeah, I've got a different graph I'm gonna bring up in just a minute, but a lot of it's tech. We'll see overweight in tech, I would say. So, and that's just because the biggest companies in the country right now are tech. It may not always be that way, but tech's up here. And then right below it is consumer discretionary. And then right below that, I believe, is industrials. Now, some of the biggest equity positions with the biggest increase in alpha over the last, call it 20 years. Percent of fund, Apple, Microsoft, Amazon, Nvidia, Google, Meta, Berkshire Hathaway, Tesla, and United. So of the top 10, 8 are tech. Berkshire and United Healthcare are obviously not tech. So this is very heavy tech. So when tech does very well, VTI does very well and vice versa. So it may be good to have some kind of a hedge there. If you're just going to invest in VTI, maybe invest in gold or treasury notes. It does pay a dividend, and they're paying out, those are paid out every quarter, and you can see some of the fund management here. But what are the big things to take away from this? Well, VTI is a great all-around performer. If you go back and look over the years, over the 10-year mark, what's it done? Here's the price. It's opened, 10 years ago it was 93, and today it's 206. So obviously a great return for your money. Not something that you're gonna run up against an individual stock like a Tesla or a Google in terms of performance, but it basically is tailored to mimic the S&P 500, provide a low expense ratio, and it's passively managed, and it connects you to basically everything. Now, on the other side, the ITOT, which is a BlackRock index fund that goes over the same thing. Total US stock market, year to date, 18.93, so almost the exact same as what VTI is. And I should mention, these two funds are interchangeable in a lot of different portfolios. So for example, in mine, when I tax loss harvest and I have one fund that goes down in price, maybe it goes down 5-10%, it'll actually sell out of that. And if it's VTI, it'll buy ITOT. And if it's ITOT, it'll buy VTI. I can absorb those losses through tax loss harvesting to offset my gains for the year while buying a similar security at a reduced price, therefore offsetting any potential capital gains and so on and so forth. So I just keep doing that. I have tax loss harvesting turned on. It's a great way to make sure you're getting all the tax advantages you can. So similar to VTI, it's a low-cost way to access the stock market, the U.S. stock market, I should say. Ranges from the small to large, so we've got small, mid, and large cap, and it seeks long-term growth with a very low expense ratio. They do pay a dividend, and if you look over the last average annual return, of the last 10 years, 11.32%. And some of the key facts are, let's see, where's the expense ratio? They've been around a little bit longer than VTI, so maybe that's important to you. Let's see, they're on the S&P 500. Distribution frequency is quarterly, and where is it at? There we go, 0.03, so exactly the same as VTI. And again, you're getting a lot of the same exposure here when it comes to what you're purchasing. So Apple, Microsoft, Amazon, Nvidia, Google, Berkshire, United, Tesla, Eli Lilly. Now that Eli Lilly is almost a $500 billion company, is starting to creep up there as a big percentage. So let's see, weight 1.07. So you really got a lot of the same weight, and you have a lot of the same exposure. Here it's a little lighter in IT or tech at 27.83 versus 30. I think VTI's second was consumer discretionary, and then you've got financials and healthcare as well with Lilly and United Healthcare. So we've talked about expense ratios, we talked about performance metrics, we talked about the cost and past performance of ETFs, we talked about the diversification and the holdings metrics, but what investor was suited to buy which one, and which one would I ultimately recommend? Well, if we actually go over here, we can see a complete breakdown and what this looks like. And I'm gonna make sure to link this down in the description. So if you wanna look at these ETFs side by side for a complete breakdown, you'll be able to do that. Now, first thing I'll mention is if you're a Vanguard person and you only invest in Vanguard, don't go over to BlackRock just for this ETF. Buy VTI and you're good to go. So that's a personal profile of what I would say an investor looks like if you're looking at which index fund to go with. Now, if you're already in BlackRock, obviously go buy ITOT, but let's say you're using something like a Robinhood or a M1 or something like that, and you have the option to choose either. Well, it really depends on the number of holdings. The expense ratios are the same. The assets under management, VTI is going to have a lot more. The daily volume's obviously much higher. But I'm not kidding you. I just sit and double click. The return for both of these are basically mimicked. So your eyes aren't fooling you. They're stacked on top of each other because they're extremely similar. However, over the last over the last year, VTI's up almost 0.5%. It's exactly 0.5% with the same expense ratio. So VTI right now is actually beating ITOT, but again, that's over the last year. Like I said, same expense ratio, the spread's the same, and the daily volume's much higher for VTI. I believe they have the same top 10 holdings: Apple, Microsoft, Amazon, Nvidia, Alphabet, Meta, Alphabet, Berkshire, United. So if you like Exxon over United, maybe pick VTI. And then the countries are basically the same. The market caps are a little bit different. VTI is going to have more, And then this is the meat of it right here. If you're more interested in health tech or finance, if you're more interested in finance, go with ITOT. And if you're more interested in health tech, go with VTI. That's about all I can tell you in terms of which one to go with if you're just doing it on a as needed or picking one. And the distribution yield in VTI is just a little bit higher from their dividend. And then you can also go down here and see how their the MSCI looks like. So my final thoughts, which one would I choose? Well, if I actually go back into my portfolio here, you can see that I have VTI as well as ITOT, and they're doing exactly like I talked about. ITOT is the tax loss harvesting alternative to VTI. And if one declines in value, they'll buy the other to harvest the losses and so on and so forth. So I did trick you a little bit because I own both. I own both for a reason, and that's because when one goes down, I buy the other, etc. Two different firms, basically the same expense ratio. I do prefer VTI. The yield on the dividends a little bit better. They're a little bit heavier in tech. They've been around almost as long as ITOT, and they've got more assets under management, so they can pull their weight just a little bit more. But again, neither one's right or wrong. It all depends on what you're doing. As I've said before, stick with what you know. If you've been a Vanguard person, you've been a BlackRock person, stick with those. You're not going to lose either way. So let me know, comment down below. Let me know which one that you're invested in. Let me know if you knew this. Let me know if you would love to see more of these ETF face-offs. Don't forget to like, subscribe, drop me a comment. And as always, don't forget to design your financial freedom. Take care. Bye-bye.